The Hedgeless Horseman here again, second video. Other one got so long that I thought I would do make it into two parts. You know me, I can't make it short even, for the life of me. Anyway, thanks for the sponsors. I thought I would just continue on a few points here that I actually didn't even get to finish, but in the last video. So, where did we drop off? Well, I thought I would talk about this actually. I mean, last video I talked about, I think juniors are still so cheap. Again, assuming they actually have something that is cheap. If a project is shit, and that's for most of the juniors, that has zero value regardless of what gold, silver, copper, nickel, yada yada is worth. If it's never gonna be a mine, or not going to be a mine in the next 20 years. It doesn't matter what they have almost. It's de facto worthless. So, that's never cheap even if it goes down, and because the downside is, 100%, etc., etc. That doesn't stop them from some of them going up the most, but anyway, that's not investing. That's just, greater trading sardines, or greater food trading sardines. One thing, and I've talked about this before, I think, where it's like, historically we've been used to the sector trading at whatever X amount of dollars per ounce, right? That's like, well, the mining sector, gold mining sector, has more often than not sucked because mining companies do a bunch of mistakes and they pay very high prices when margins are high. They overpay and then destroy value, yada yada yada. And then there's been like whatever, almost rule of thumb that's like feasibility ounce is worth $200 per ounce, or this junior is cheap because they're trading at $20 per ounce, yada yada yada. Usually that doesn't matter because those ounces are never coming out of the ground. Obviously, vast majority of, let's say, gold mining projects belonging to juniors will not be a mine, and especially not in the next 10-20 years, let's say. So de facto they're kind of worthless, right? Unless they get acquired, but who's going to acquire it if they are worthless? But even if the market ignores the fact that the gold is as high as it is, right? But if you have, and I've talked about this, why I especially love the Lassonde curve as of late, where it's like, if you have a project that's a good project, and it's trading for $200 an ounce or something like that. And historically, you could say, yeah, that's about right. But it's like, when you think about it, let's say they have an ASIC of $1,300 gold. And a project could be in production in, let's say, 2 years. I'm just making up a timeline here. At face value, if that mine was in production in 2 years, it would be making $3,000 margin per ounce. Not $200. Even net profits is going to be more than $200. Let's say net profit is whatever, $1,200. Something that's a lot more than $200 at least. So like, I think the junior sector is kind of asleep at the wheel in a sense, and I think it's in a somewhat stuck in the past, because obviously a good reason, and I've talked about this before, where it's like nobody's seen anything like this. And if we think about it, for whatever reason, let's say that the gold miners tended to have the same. I mean, I think I might be mistaken, but I'm pretty sure that some of the mergers and acquisitions like 20 or 30 years ago, ounces were, let's say, let's take Integra Gold for example. Not Integra Resources, Integra Gold. They got bought for a premium what the NPV was at spot prices, right? And I don't remember exactly what NPV that would be per ounce, yada yada. But I know that Amex, for example, which also has a high grade deposit, and according to the PA, if you use ChatGTP to kind of predict the economics, and I know that's very quick and dirty and all that, but that's spat something out like $2.5 billion. Obviously, Amex is not trading at $2.7 billion or something. Spot premium to spot NPV is more trading at like 500, 600 million or something. My point is like this weird thing where it looks like almost ounces in the ground kind of have been fixed. And even going back to when the gold price was like $700 and companies were acquired for maybe $100 an ounce or $200 an ounce or something like that. Whereas like and some of the developers, even I think the good ones, they kind of have the same valuation, like the historic norm. And we've seen some. I mean, you've seen take unders, I was gonna say, whereas like gold went up, yada yada, and it obviously much higher now than it was, in the bottom, $1,100, etc. But it's like the takeovers weren't that impressive. So it's this weird thing where it's like, yes, one could say though that hey, over the long term, gold goes up 3%, inflation goes up whatever, let's say 2-3%. I mean, now probably a lot of people would argue it would be more, and you could say, well, the margin should be fixed. Sure, I can see that the margin should be fixed. Let's say you should be making 30% margin on the gold price. As a gold miner, or 20, whatever the average is. I mean, maybe it's actually negative given how shit this sector has been. But my point is that, well, still, if you adjust that the margin is the same, gold price obviously inflates over time because it's pricing in increased amount of fiat out there. So in dollar terms, that should still be going up. If people acquired projects like for $200 20 years ago, like good projects, maybe that should be like $600 today. And to be honest, given that the margins now on some good projects would probably, if they were in production, would be like $3,000, they should be up even more. So I think, this is just my thoughts, that I think still some of the gold developers that have a legitimate threat of becoming mines with a gold price anywhere close to here and the margins anywhere close to here, they're de facto super cheap. Could gold go down? Sure. Could the mine build get worse? Sure. But if you look at some of the projects out there, it's ridiculous how much money some of those mines could make, and they're still not, in my opinion, really pricing that in. And then we can look at, well, second part of the Lassonde curve. I mean, why is there a case for the second part of the Lassonde curve? Is because people hate to wait, right? So there's typically a ramp up period in price of the company going into commercial production, because that's when rubber meets the road. And if gold price is indeed 4,300, and if they do indeed have a $1,300 ASIC, you will indeed have a $3,000 margin. And of course, then the company is not going to trade for $300 an ounce. So it makes sense, and the fact that it's a ramping period and all that. But if it's beyond, somebody said there's like nowadays the Lassonde curve, that's like 9 months before production. That's when, I don't know if that's when it starts to run, or if it's already actually almost quote fully priced 9 months before. But anyways, like I one of my favorite expressions are you can ignore reality, but you can't ignore the effect of ignoring reality. So GDX and GDXJ are not ignoring the fact that gold prices are where they are and that they will probably beat earnings estimates. Well, that might not be priced in, but that they have beaten earnings estimate. The gold has in fact gone up. But then if you look down into the junior sector, I don't think the high quality projects are pricing in. I mean, even if you again took some company that's like, oh, it's 3 years from production, they're gonna raise their entire market cap in production, so double the market cap, let's say. I mean, probably if gold prices are high, they probably can do a lot with debt. And then, I mean, when you see the paybacks on some of these projects, assuming everything goes kind of according to plan, I mean, the payback periods are like a year. And that's just disgusting. It's like, imagine if you had to wait 3 years. You give someone, well, you buy something for $100 and you, let's say, raise $100 extra. So it's like, okay, in 3 years I paid total sum of $200, but gold price where it is, that mine is going to be making $100 per year. So the capex get paid back in 1 year. So in 3 years I'm getting a 50% yield, free cash flow yield, for example, for the next 10 years. How much should that be worth? Should that even be available? Sure, you have to wait for 3 years for it to start, but after that you're getting 50% yield on your entire investment for 10 years. And let's say they have, expansion potential and whatever, another project and yada. I mean, that's an outrageous return. That's why I like especially still the second part of the Sun curve, because they're still, again, kind of ignoring the fact. It's like it's stuck in the past in a sense, where it's like, nope. Ounces in the ground, they historically trade for whatever. PA stage, they trade for $50 an ounce, and then PFS $100, and then FS $150. And nobody asks, yes, but what is an actual ounce produced coming out of the ground? What does that throw off? I mean, if it threw off $500 in margin, maybe a feasibility price of $250 per ounce is okay. But if it's $3,000 per ounce, 250 sounds absolutely loco, right? But who in the history of the who's alive today has ever seen $3,000 margins? Nobody has. So that's, in my opinion, I think that might actually be a kind of a blind spot, and that's why I think we're going to see much more M&A, because why wouldn't you? I mean, if I had a gold mining company and I could buy, I mean, we did see, and I talked about this kind of when it happened. I mean, we saw, the Rob McEwens making acquisitions, the Pierre Lasson's with Orla making acquisitions. Who else? I mean, Agnico Eagle, done a few acquisitions and yada yada. So it's like the quote smart money, they seem to get it. They were buying stuff, and it's like all of us, even Kinross. I mean, that looked pricey at some point, but I don't know where great the Dixie project is in terms of how advanced it is, and maybe it was kind of pricey at that price, but still, I mean, if that's going to throw off 300,000 ounces a year at good ASIC, I mean, that's going to be a lot of money at today's gold prices. And also, I guess, to just point out, I touched on this. Was it this or maybe last video about the pressure of hodling as your portfolio might be hopefully increasing. And if imagine we have 5 years bull market left. That is like the trend is typically up, but yes, we're not going to have a maybe vertical movement every day. We might have a year of consolidation, etc., and then a pop, and then consolidation, etc. But like generally the trend in 5 years, the miners are going to be higher, gold is going to be higher, silver is going to be higher, maybe copper is going to be higher, oil is going to be higher, yada yada. Then you obviously have to kind of be able to stay the course, and you can't be too much of a scaredy cat in a sense. Well, okay, I'm up 100% in this position now, and I've never had 100% green in any position, so now I'm gonna sell because I can't take the pressure, and my portfolios, especially after I suffered this sector for 4 years and saw my wealth go down. Now it's up and maybe all-time highs. You're in the green at least, even if you started buying in 2020. So now you have more exposure than you had 5 years ago, but you remember how much it sucked after the next 4 years, so you're afraid of that, and this time you have even more to lose. that's not. I mean, that's something nobody can really teach you, of course. Uh, but it's like, okay, how do you know how do you get a well, it just reminds me. It's like I've talked about this maybe before, but talked with a CEO who's made a good point. It's like uh, if you're like, oh, I want five baggers, and then it goes up 100%, and you're like, well, I'm gonna sell it now because it's not a five bagger anymore. Well, then you're technically not even after five baggers, right? Because you never wait long enough for them to become five baggers. And I mean, there's some take some of the. This is one hodl folio where some of the top performers so far that are currently held. I mean, maybe sold some stocks before and they're not up that much. Let's say. Um, what was I gonna say? Well, I mean, a 10 bagger, whatever bagger, it's just a bunch of consecutive 1% hodls in a sense. And sure, I mean, yes, Friday we had a pop in some, and all of a sudden, I mean, it's not 1% per year, but it's like from take Magna for example. If that doubles from here, that's more than a 10 bagger, right? So my point is that it's like if you can't hold something being up 50% or 100% to you're never gonna get a 10 bagger. And why do you need to hold winners? And it's like not for the sake of holding. If they're expensive or something, sell them. But if there's no obvious reason why, I mean, take profits is one thing. That's fine. It's like to take some profits along the way if the position size gets too bloated, for example. But the thing is, it has to more amortize, as I think Rick Rule would say, losers. It's like you don't need to have all winners, but it's like nowadays, especially with the holdings in at least some of the hodl folios, like there's not that many that are red still, and some are like fresh in the sense that where it's like, well, no, it's not fresh, but Rakla. Uh, I mean that news came, and that's the things like downside, especially in a high risk, high reward pre-discovery drilling, when they have one target, the downside can come like that. But if Rakla, if the grad target were to be a success, the upside wouldn't come like that. So how do I pay for a Rakla with another Rakla? If I have one other Rakla, I need to hold it until it's up 84%, but that's just to pay for this Rakla. If I want to make money, I have to be able to hold it more than 84%. If I have two Raklas, I need 169% upside from the third Rakla to just pay for the two Raklas. My point is you have to get, I mean, well, I should also qualify that by the higher the risk, the more you need to get out of the winners, by definition. So let's take Magna, for example, which was, in my opinion, a very low risk bet. You need to get, let's say, 440%. No, you don't need to. If you only had a bunch of Magna cases, it was like, hey, this is like, easily it's gonna go up 100% from whatever level. Easily. And in your mind, it's like, there's no downside, pretty much. You can take profits whenever in that case, theoretically. But the higher the risk, take a Rakla. If the risk is high, you need high rewards for those cases. So I can't be really, I mean, if we're talking like actual game theory, I can't invest in 10 Raklas, have 3 Raklas become successes. Like the grad was as good as it looked in those cases, and I sell them all at 100% profit. That will not pay for 7 Racklas that go down 84%. By definition, that's just math. The higher the risk, the more losers you're gonna have, the more you need out of your winners to pay for the losers. So it's the risk that is at least gives you the threshold, what you need, how long you need to run a story, how long at least you need to, because yes, there's cases where it's like it looks like it's going well and then it doesn't go well. That's kind of, you almost have to suck that up. It's the risk of entry in a sense that dictates what the minimum ballpark of returns you need. But the point is, you don't need every winner. It's like this portfolio, for example, is over this period it's up 517% since whatever that is, June 2019. That beats the GDXJ. I mean, this portfolio is up, I think, 58% this year, if I'm not mistaken. GDXJ is up 167, I think. So this is being outperformed 3 times by GDXJ. And I explained that in my last video, I think, where it's like I do more of a all-weather approach, where it's like my portfolio, since it's juniors, they typically lag, especially early in a bull and all that, and they get absolutely crushed in a liquidity event. But typically the trend is still up. 2020 to 2024, when I think even GDXJ traded down, this portfolio actually gained some over that period of time. And what I'm trying to point out is, like, don't get too much FOMO from people putting up their annual returns this year. You don't even know if they're true. You don't know how much money they have at risk. You don't know. Anyone could create a bunch of different portfolios. Even, in the case they even show the portfolios. Whatever, the one that works best, that's the one I'm gonna point out how well it's done this year. And in my case, for example, I'm all in. I don't have like, oh, this is my junior portfolio, and that's just part of my mining portfolio, and that's just 10% of my net worth or something. Of course you're gonna be more able to do more speculation and gambling, whatever, because you have less to lose and you have less capital. The smaller capital, the more nimble you are, etc., etc. So it's one thing also to keep in mind is that, well, okay, to make the point here is like, don't have too much FOMO. What's the goal with investing? Is the success or failure, is that based on if you're beating the GDXJ this year, or if you're beating everyone on Twitter, which is impossible? No, it's not, right? Investing is that, well, what's a good outcome for investing? If you're a stock picker, I would say that you, over the long term, beat an index, right? Well, at least you get positive returns, right? That's, I guess, the lowest bar, that you actually make some money over the long term, because as you can see, there's no shortage of losing money in the market, especially the junior sector, over any period of time. Most of the time this portfolio is not going higher, it's just treading water or going down, right? Even though it's going higher here, it's still not higher than here until here, basically. Went up for a bit, topped again, traded down for 1 year, traded sideways. It wasn't until here. You know what I mean? It looks like a disaster. 95% of the time it looks like it's going nowhere. But as long as you have an okay strategy, you're gonna do well over time, and that is the important. It's the who has the Who will have the typically the best portfolios any given year, any given month, even any given day, even? Who do you think is gonna? That's why I don't really join the pick three. What I was gonna say. Why I don't join the co.ca stock picking contest? Why? Because if there's 1,500 entrants, and I legitimately wanted to try to have the best return, uh, then I would pretty much by definition, by definition, have to pick up or put in three super high risk stories that theoretically could go up 1,000% in 1 year. That's pretty much it. There's no way that even if, let's say, GDXJ goes nowhere over the next 12 months, and I pick a portfolio of three really solid low risk cases and they actually go up 100%. So obliterates the GDXJ, doubling your money over 1 year. So superb returns all around. Do you think I have a single shot at winning that contest with 100% return? No. It's pretty much always won by someone that has either one or two hits in some micro cap or nano cap company. And if you have 15,000 people or whatever it is doing that, it's like you can throw darts at some nano caps, and one of those portfolios is gonna, one of those portfolio of picks is gonna win it. And then the opposite is, well, am I gonna put in just the ones I think are, I think for me are the three best cases I know. And that might be a case where it's like, this is an easy double, where it's like, that's too boring for most people, whatever. But then I'm putting them as entrants, not because I think they have a shot at all of actually winning the contest. Then it's just really to get eyes on whatever case I'm having, and then I feel disingenuous. I'm probably silly, take it too seriously, but it's like, that's some of the stuff where it's like, yeah, sometimes I actually long for the time where I don't maybe have too much of a public figure and have to think so much about what I say, etc. Maybe I'm silly, overly conservative, but I hope that makes sense. But my point is that if you want to have the best returns of anyone, let's say the mining sector, you have to either gamble or take too much risk, or at least high risk. Let's put it like that. So I could theoretically have this, just an example here. Let's say I do a portfolio, or I take all my money, if I could, and I put it in, let's say, and I'm not saying these are gonna, go up that much, but theoretically, where there's a shot of them going up a lot, let's say I put all my money in Inflection Resources, Red Canyon, and what other one might that be? Let's say Altamira. All could. It's like two of them pre-discoveries, in a sense. If they hit something, given the market caps, if they hit what they're after, they could go absolutely bananas, of course. That's very much an if question, not a when question. Red Canyon Inflection, and then Altamira, because that's not really, in my opinion, a high risk high reward story, but let's say they have some whopper holes, or they make more discoveries. Maybe that's actually too boring in a sense, because they already have over 1 million ounces. But let's go with whatever. I'm trying to come up with some Westward Gold, for example. Yes, who are looking for Carlin Gold. Let's say I make a portfolio of those three. Let's say two of them actually make a discovery hole and all that, and spend the rest of the year, following up on that discovery hole, and it gets better and better. Let's say they are up 500%, and let's say the other one is plus minus zero. I'll probably have one of the best returns in the sector. But what does that mean actually? Next year, I pick three similar stories, and all of them. Let's say, or I put three that only have one target each, but all similar kind of characteristics. If they hit, they could go up 500% in 12 months. And they all fail. So I cut my portfolio at least in half. So and let's say over that time period, GDX, instead of going, having no return, zero return, neutral, GDX or GDXJ goes up 50%. And I'm down 50%. So I went from 1 year having, let's say, one of the best on Twitter, and let's say I legitimately had that return because I took so much risk, aka gambling. Next year, I'm not going to post what my portfolio did, or probably not at least, because I cut it in half and the GDXJ went up 50%, while I cut my portfolio in half. And let's say the year after that, I do the same thing, and now I'm a bit on tilt because now I really need the win, because now I look really stupid for a year. I do the same thing, and maybe those three bust out as well. Now I'm down 50% again. Whereas like some happy-go-lucky guy who's like, I just hold the cheap stuff that I think is going to go up 50% per year. I mean, let's see, it's right, and the surprises come to the upside. Up 50% 1 year, up 100% 1 year, 50 the next, 100 the next, 50, whatever it might be. He's going to, probably kick the gambler's ass, but he's never going to have any single year where he actually get to brag too much about what his return was. So my point is, you have no idea how other people's portfolios are. You have no idea what risk they're taking. You have no idea if they are playing with 10% of what they have. If you trust some people are obviously more trustworthy than others, etc. But you still have no idea what they did. How much risk did they take? How much was maybe luck? So don't as I try to show here, it's like, hey, this portfolio is underperforming GDXJ big time this year, and that's okay. I think this portfolio is much cheaper today than GDXJ, so it has more upside than GDXJ. And over a longer time period, even despite getting my ass kicked for this portfolio by GDXJ, this hodl portfolio, which does very little trading, still has outperformed GDXJ by a lot, I think, since let's say June 2019. Yeah, 245. Okay, so it's basically, what does that make it? Let's say doubling it basically, with even more upside in my opinion than GDXJ from here. So it doesn't really matter. I mean, if I was a perfect trader and all that, I would be in GDXJ when GDXJ or I would be in miners when they run, etc. And then switch to gradually then to GDXJ and then to juniors, etc. So my point, I guess, is that it's like it's you live by the sword, die by the sword. And I think it's hard to be an expert on everything, and then at the same time, I mean, even if you're lagging, let's say GDX and GDXJ has kicked your ass, and you're in you're stock picking juniors, let's say, and let's say you're in Liberty Gold, and I don't know how cheap this is, if it is even is cheap. I'm just making a point here, and you've been, let's say, underperforming the GDXJ. Let's say you have underperformed. Let's say GDXJ is up here, or relatively speaking, let's say it here, and let's say this is fair value. So you're here, GDXJ is there, you gotten your ass kicked so far in 2025 by GDXJ, but this is all GDXJ has left, and this is all baby your stock picked juniors have left. So when all is said and done, you're probably gonna kick the ass of GDXJ, but until then you're lagging. That's all there is to it. It's like lagging. If any portfolio that's been concentrated into producers will have done the best up until this point for 2025, and if silver goes up or gold goes up, whatever, they might continue, or they should continue to do well. So maybe they're up here, and it's like mine, really, really good returns, really good returns. But then your whatever stock picking cases, maybe some are getting into production, or in 2 years or something, or you think in 2 years they could totally have rewritten the story of the company. And it's like, again, if we go and then add that the sentiment is returning. So let's say you bought something for $100 per ounce and they have 1 million. In 2 years they have 3 million ounces, and let's say they're even on the way to production. Now I'm making up a case to prove a point here, and the gold price is at $5,000, and the gold miners have gone up 100% more from here, so they've outperformed relative to today even more. But it's like, well, in that future, and let's say in 2 years, it's like now this junior is not that far off from actually producing, and the producers at that point in time have $3,500 in margins, and you bought 1 million ounces for $100, and now it's 3 million ounces, and those 3 million ounces are about to get a $3,500 margin as they're getting pulled out of the ground. So 3x ounces, and de facto value per ounce. Let's say honestly that let's say whatever net profit. Let's say it's $1,000 per ounce or something. So $1,000 per ounce when in production. Imagine your valuation potential. You bought 1 million ounces for $100 per ounce, and then years later, and it doesn't matter, take 3 years, take 4 years, whatever, just think about the implications, because now nobody gives a shit, because it's the junior sector and nobody is in juniors. Really, they are in miners, big miners, but they've not come into juniors, etc. And nobody looks 3 years out, nobody looks 2 years out, nobody looks 1 year out in this sector. Few look 6 months out. So you're buying this future that you see, and only you see it, because it's totally blind to the market. So you would then have a scenario where you bought 1 million ounce for $100 per ounce, and in 2-3 years, whatever it might be, what you hold is 3 million ounces, and in terms of production, every ounce coming out of production, of course you might not get $1,000 necessarily per ounce in the ground, because they're not all getting produced at the same time, but still 3 million ounces are going production, and the production now is $1,000 per ounce. That's quite the revaluation. Even though, again, you're not gonna have, what is that? It's like 3 million ounces times $1,000 per ounce. Now I'm too tired to do any good. I don't remember. I have done some calculations what an ounce of production, or if they're producing 200,000 ounces per year, what's the market cap of the company per ounce produced. It's not like they again that the market is going to discount all the profits on all ounces, like they're not going to take 10 years to come out. But regardless, I mean the point is that if you bought it for 1 million ounces at $100 per ounce before that, I mean the revaluation potential is obscenely more, much higher than if you bought one that had already performed, and gold does indeed go up, and that goes up 100%. Whereas like this junior, that let's say they create value, and all of a sudden when rubber is meeting the road, aka now it starts to matter what the actual gold price is. Now the market can't really ignore it, because the market is not gonna ignore the market is not gonna ignore if a mine is a 1 day away from full scale production, and it's expected to again make like 300 million per year or something. It's not going to be trading for 200 million or 300 million, whatever. It's going to get forced up, and who knows, maybe 8 times that. So that's my point. If only that happens, does it really matter that you have periods of time where some other strategy, some other portfolio composition absolutely kicks your ass? No. Right? So again, what is important? Is it so bad if you underperform GDXJ or GDX or whatever, a gambler or whoever on Twitter? You have no idea. I mean, on Twitter, everybody's a genius. Everybody's printing money. You only hear from the people who have good years, or typically you only hear from people who have good years, good months, etc. Some are absolutely 100% legit. That I mean, what they say is absolutely true, but you still don't know, their strategy, their portfolio composition, yada yada. Some include warrants, some do not include warrants, etc. So it's like my point. This is kind of copium, I guess. Is like focus on getting solid long-term returns. Forget about everything else. You have no idea what other people are doing. You have no idea what their track record is. Because again, most people you're gonna hear from obviously it's like a highlight reel for whatever, Instagram or Facebook, whatever you want to call it. It's like people don't highlight. It's like, oh, I lost my job today. It's like brag about that. No, it's like people tend to highlight their winners. I mean, I try to not congratulate myself, because this is my job, and investing is my job. If you're super excited and surprised about having some that work out, so far at least, then it's like, well, you really shouldn't be. I mean, this is what it's about. We're taking high risks. We need high returns. And it's not like this is the entire portfolio. No, you have to subtract the losers. You have to maybe some of these cases have been playing out over a 5-year period, and in that case it's what the compounding is. I mean, I would have to calculate it manually or respectively. But it's like it looks more sexy than it is, and then it's like, okay, what am I? Oh, should I be bragging? It's like, hey, this stock is up that much, but it's not like I had my entire portfolio in it, and maybe I talk about some winners to sell them, because like anytime I have a loser, I almost always have a troll that oh, this guy must be bust by now. Because I think it's a bit tacky. It's like I try to let's say train myself to not need that validation ego thing. But I'm hey, it does feel good to look good. But yeah, so it's like, yes, this chart includes those cases, but as you can see, it's not like it's an exponential chart or anything like that. That's the thing. So it's like, but if I would just be posting about whatever, let's say, a store that has done well, it's like That's not this hodl portfolio's return. I mean, Seropasco is, let's say that's been a position for a year. This portfolio is not up, whatever it is. Zero. Where is zero? Oh, this is wrong. 253% in a year. K2 maybe 6 months. No. And then also it's like some of these cases, some more than others, of course. Maybe they went they've been closing the price to value gap a bit much. So you take some profits. So it's like the when it went from, let's say some went from minus 30 to plus 100, maybe you had most of the position there, but as it goes to 200, 300, maybe you have scaled back a bit, so it has less impact. That's the stuff you don't see, of course. And as always, when people say I had a 10 bagger in whatever, it's like that. The amount of times I have had a legitimate 10 bagger, I could count that on maybe a couple fingers. And what I mean by that is like it's 10x and you literally have every single share. Otherwise, I mean, let's say I have Probe Gold, for example. It's not much in Probe Gold anymore in this portfolio. So that hasn't really contributed that much, but it's up. The shares that are left are still up 414%. But Probe Gold's actual impact to the portfolio has been negligible. Why? Because I sold most of it long before it went up 514%. So if I say, take whatever. It's like you see that all the time. It's like somebody's like, hey, look how smart I am because it's the pick is up 10x or something. Or it's like in reality, the same person might have sold everything after it was up 100% or something, or have 5% left of the position. Because sometimes you see it's like some people post some pics. It's like, oh, look at this, and I was right again on yada yada, and then you're like, well, why aren't you posting your portfolio in that case? If you only have a bunch of 10 baggers, allegedly, if that was your entire portfolio, you should be up a lot. You should be up 50,000% or something. So it's like, hey, sometimes you're going to get punched in the face, some you're going to make money on, but again, just to harp on the fact that, okay, it's the winners pay for the losers over time, right? Like recently, Finex and Rakla have achieved quick paper losses. And how do you pay for them with paper gains? Not many juniors. Both of these got hit with it in a short time. I mean, this Rakla got hit like 3 times in a row, but I think it went down 60% on the initial made and real results. But it's like, how many of these do you think just pop 60% in a day? No, it might take 6 months for one of these to go up 60% or something. So it might take 6 months to have a winner pay for a loser that took 1 day to manifest. Which by default then means that, oh, right, I have to have some kind of hodl time frame, because there's just simply no way for anything to become a winner, especially a winner enough to pay for some of the losers that still can become losers in a single day. So I don't know, to wrap things up and note, it's like this is not buying or selling recommendations, and you shouldn't be buying these because they're up in this portfolio or selling these because they're down, or buying and vice versa. I might do some value shuffle and all that, But like these are, I mean, as of whenever I took this picture, well, that was like an hour ago, I think. These are some of the current holdings and what they're down and up, but it doesn't show how much of the portfolio they are, how much profit taking has been done, how much they actually have contributed or anything like that. So don't, this is all that matters. Again, going back to that, the only thing that matters is the long-term returns. 1 year doesn't matter, 1 month doesn't matter, one case doesn't matter, either for the upside or the downside, unless you're all in, and you should be all in one stock. Yeah, and also going back to the difference of risk and or gambling and whatever. Let's take silver, okay? Let's say you were in take what was I gonna say? Yeah. Let's say you were doubling or averaging down, and I was way dumb enough to do that actually here in producers. I mean, back here when I started off, I legitimately kind of did a spreadsheet looking what silver juniors were down the most. And I remember like Endeavor and maybe First Majestic and stuff. I mean, they were down like some were down like 97%, some were down like 93%. And to me, it's like, okay, if they're down that much, it means probably that the most of the downside is done already. But of course, if something is down 95%, if that gets cut in half, it's down 97.5%. So just that extra dip could still be a 50% lower. It's why it's very, very brutal in the beginning. You can be really, really early, or you can almost have perfect timing and you can still have a 50% paper loss. But my point is that it's maybe not as applicable now because like before silver ran like crazy, silver prices were actually pretty good. But sometimes, let's say you were investing in silver producer, marginal ones, like break even or probably losing money down here. If they all went bankrupt here, you would have gotten wiped out. If you didn't, if they didn't and you held them, what developed was one of the best rallies that any mining portfolio has ever seen. I mean, stuff 8x here, for example, in like 6 to 8 months. My point is, if you risked your entire portfolio of companies going bankrupt, being in marginal debt-ridden producers that were bleeding cash, you were taking a risk, obviously, a big risk. If metal prices didn't turn before they went bankrupt, you would have lost everything. If they didn't go bankrupt and you were still holding them and held them for 8 months more, from whatever, I mean, nobody picks the bottom, but from that low, they were probably up 700% or something. So that's how fine. So let's say you had the best performing portfolio on mining Twitter over this period. And you could brag about that, of course. It's like, whoa, you were kicking everybody's asses and their mothers and their uncles. What people don't see, and maybe that person is not aware of, that let's say if it took one additional month for the sector to turn, or for whatever, that let's say for theoretical sake that he would be wiped out. Every single company would have gone bankrupt and his entire junior mining portfolio would be worth absolute zero, 100% permanent loss. That's the scenario you don't see, of course, but that's why investing is, we can only make the best decisions we have with the current information we have. But there's a fine line, or they kind of go together actually, best returns and gambling. There is no one that's going to have typically a superb year unless they run a very concentrated portfolio. this is not really a concentrated portfolio, and it's not really a trading portfolio either. But it can, it gets the job done. It's still, trending upwards over a longer period of time, and in between it has many bear markets. And in no particular year do I think this is even close to one of the best performing portfolios on Twitter, for example. But it's like, my point is again to just keep yourself from, let's say, making too wild things, mistakes. Keep in mind that a rule of thumb is that if you want to have the best, if you want to have a shot at having the best returns in any given year, you will have to gamble or take very high risks, typically. And if you do that, it can go well. Question is, what's going to happen the next time and the next time after that, etc., etc., etc. We have to have a closed loop in terms of our strategy. If we have a strategy that it might be a disaster and it might work, how much longevity does that have? It's like, the roulette table. You bet on black, you win. You bet on black again with everything, you win. Next time you bet on black, red comes, you lose everything. You only need to get unlucky once. But it's usually the only way to have the absolute best returns. I've seen some crazy Twitter returns, and admittedly that was somebody who, even if it's true, but that said he used crazy amount of leverage, etc. It's like, or take Dogecoin. If you were early, which is a meme coin, admitted by the founder, if you rode Dogecoin from the bottom to the top, you might have made, I don't know, let's say 13,000% or something, maybe more, whatever. A huge amount of money. It's like early in Bitcoin, whatever. What you don't see, of course, is when it didn't turn out that well. And maybe Dogecoin is going to go to zero one day, so if you held out long enough. My point is that, yes, there's ways to get rich quick, and that's called gambling. And you don't need to have anywhere near the best returns any year on Twitter, and you could still do really, really well. I am not complaining about returns in this hodl folio, even though on Twitter's, like social media wise, that's nothing really to brag about. Because I bet there's someone that made 517% in some weird portfolio this year. But does that take away from the fact that, hey, I think this is a good return, and if we fast forward, if this one can do 507% every 6 years or something, that's going to amount to quite a bit of money, right? And if I can, that's why I want to continuously try to get better and better. And because if you add 2% per year, that's going to add up. Everything adds up. Everything adds up. So again, what is the actual goal? If it's to get rich quick, then okay, good luck. Good luck. You'll probably have to gamble. You'll probably have to take high risk. And what would a gamble today look like? Well, that would be like, okay, some people say silver is going to go to $200 within 6 months. So being the lowest margin silver producers or whatever, or including absolute junior shitcows that has a project that might get developed 20 years from now, but it's not even close to being worth much today. or they don't have a mine, or whatever you want to call it. That could be the best performing portfolio out the next 6 months. But is there any margin of safety? What if silver goes down? What if management team screws something up? What if they steal the company? I was gonna say. It's like that's more in the gambling region, in my opinion. Uh, so yeah, it's like keep your head cool. I mean, honestly, the way I see it, as long as you hold cheap, if as long as your portfolio is on average cheap, preferably very cheap, the risks are to the upside by default. It's just an accident waiting to happen to the upside. Of course, that would be superb if that's an accident waiting to happen to the upside, even if silver is at $40 and gold is at $3,000. Even better, of course. Everything else is gravy. The current spot prices are gravy. Everything is gravy. And especially then if you could, the ones that you can kind of force out the undervaluation is that if they legitimately have a way to go into production. Because again, a miner is not gonna be trading at $100 per ounce in the ground if they're making $3,000 margin 2-3 years from now with gold coming out of the ground. That's just not going to happen. That you can make a good case for. Which has nothing to do with silver, gold, copper, anything like that going actually up. That would all be a very welcomed bonus reward. And then a much better sentiment would be a bonus reward as well. That's stacking the odds in your favor. So it's like, I like the Sun Tzu quote, put yourself in a position where it's impossible to lose, because then obviously winning becomes a default. But I can come up with, it's like what I said about almost any junior out there. I can see how it could go up. If it's a absolute silver shitco, I can see that yes, we go into a silver mania. Silver goes to $100. Retail floods in, the stock goes up 500%. Absolutely can see that. Problem is the same goes for pretty much any junior out there. I can come up, there's no short list of reasons to or possibilities how a junior could go up. Same goes for downside, of course, but I can get myself to buy almost any junior out there. I can come up with a bullish scenario. If silver is up today and I'm listening to people, solid state batteries, and that silver is going to go to $100 within 6 months, etc. I could make a case for every single silver junior out there. I could make a case for every gold junior if somebody says gold is going to go, and I believe gold is going to go to $6,000 within 6 months. That's how quickly I can come up with a reason to buy something. But when you think about it, what kind of a strategy is that actually? The only strategy you have really is like, this sucker is going up if silver is going up and gold, and that's not even a guarantee either. That's not really a strategy, right? Or if you do that, it's like be mindful that that's legitimately that's real speculation. Let's say you buy the worst of the worst because you think they might go up the most if silver does that, and that's not even a guarantee. A, that silver will do that, and B, that those shitcoins will go up, and it could also be that even the higher quality ones go up more. But at the end of the day, it's not really a strategy. Are you gonna pitch? It's like what I think about the hodl folios. Why I actually like them in a sense to check myself. Where it's like, since these hodl portfolios are like, family members. It's like, okay, do I want to get a family member in the bet everything on these silver shit costs going up because somebody says silver's gonna go to $100, and right now it feels like it's obviously going straight to the moon. No, I mean, how many examples of vertical rallies ending well? Well, we have two in this chart. This went down 86% in not too distant future. This went down 70%. So you can imagine what the juniors did. So should I have or yeah, if we're talking long term like portfolio compounding, right now where we are, should I bet everything on this going like that? Or should I account for the fact that this could also go like this? If I buy something that I think has legitimate value, and I think that's cheap or fair valued here, and all of this is free upside, and this then by default becomes free upside, that's a completely different case, right? Then paying fair value for this, and my winning condition is that silver goes like that. In the former, all of this is free upside in a sense. In the latter, this is a requirement. This, in my opinion, is gambling, speculation. This is value investing with exposure to the upside. More value investing, margin of safety with free optionality to the spot price and the potential future higher spot price. Anyway, I've done this video long enough. I honestly kind of not sure exactly what the theme has been for maybe any of these videos, except for I think just trying to give some perspective and get people to have your eyes on the price, and just hammer home the fact that like the goal is not to make only make money and the most amount of money in one single short period. It's legitimately to have your portfolio go like that. I mean, in my opinion, at least. Sure, you could theoretically, where it's like, yes, if I get one bubble right, then I'm gonna whatever. It's like that famous saying, I think it was Munger Buffett, where it's like he saw in the oil patch, he saw a bumper sticker that said something like, just give me one more bull market, I promise not to waste this one. I think that was kind of the idea, was that in the booms everybody makes a lot of money and they do a lot of stuff, and then the bus come and then they will lose the money. I mean, basically like here. I mean, yes, if you had a silver junior portfolio here, for example, and from here to here you were up 1,000%, but 2 years later you had given everything back. I mean, yes, at one point in time you were up a lot, but you live by the sword, you die by the sword. You gave it all back. What we want, of course, is not that to have in my opinion, to just be in a strategy that only works to the upside and then gets absolutely killed rest of the time. I much prefer margin of safety, where it's like the risks are to the upside to a pretty good degree, and you have actually, I mean, you have some downside margin of safety, and of course, even more important, if you have some alpha, where it's like the company can actually create value, because honestly, even though this was a fat long bear market, there were success stories in those times. So I mean, if you on average can make money at any almost any point in the cycle, or it's like not lose much when it goes bad, but make quite a bit when it goes up. I mean, that's kind of how this portfolio, I guess, in a sense, has outperformed GDXJ. I mean, it doesn't do as good in the rips, especially not yet at least, even though the juniors can rip the most. But that's mostly thanks because it doesn't just follow the gold and silver price down, because the companies actually create value. I mean, take Magna for example. I mean, it's pretty much a completely different company today than 3 years ago, and that's this. I mean, for the better, and that's despite the price of nickel being lower than when basically they listed. That's, I mean, the definition of alpha. Even with uh, even with the macro, the price of the commodity Magna was at least founded on nickel. The stock has still gone up. So again, for a nickel stock to do this, or quote nickel stock, I mean, they added, a copper-rich asset and all that. But it's like you were betting on the management team, and now, even now, it's like all the nickel they have. That's like a free optionality now, for example. So yeah, I hope you get my point. It's like there's a completely different thing. This is not a trading sardine shitco that only goes up if silver goes up. And if silver goes down, you're gonna get crushed. No, that was like these guys are gonna create value. If nickel prices go higher, great, bonus. And even without that, they still were able to make it work. So if you have I mean, if you can translate this to a strategy, it's like, well, that's great. You actually made money in a bear market for their primary metal in a sense, and then they also, I mean, yes, you could look at it different ways. Where it's like, well, they actually acquired some copper-rich assets, so it took on the more of a copper junior type of thing. But still, I mean, copper is, yes, around all-time highs, I guess, but it's like Magna's done better than that. So that's my point. It's like Magna has kind of been an all-weather kind of situation because management is so good, and now instead you kind of have the optionality on nickel, even though you made money. I hope that makes sense. So, in my opinion, personally, I go for an all-weather approach where I look at cheapness, and that also means that uh, in the rips, my portfolio pretty much always, pretty much always lags. Nowadays, I would say, because the cases are not really tied to the metals, what they do on a day-to-day basis. And I would not be that surprised if this, if the hodl folios and my own portfolio might, let's say, have a, pretty good 2026, because I am very much overweight in the stuff that has not moved yet. And I've been underweight in the stuff that has moved. And then again, people can say, well, then that's opportunity cost. And yes, I wish I, in a sense, could be a perfect trader, where it's like I knew exactly when metals were gonna rip and the producers were gonna rip, and then just shuffle down and down and down. But it's hard to keep track on every segment of the sector. And again, even if it lags, I might still make more at the end of the day than these ones that ran first, and then I can't really complain about much, because then you're at least beating the sector, or beating an index. But sure, you could possibly tweak it in a sense, but that's how I look at my, I mean, if I can't really draw here, I guess. But well, okay, let's do like that, where it's like a miner, for example, and then more my portfolio might, let's say, a junior's like lagging in a sense, where it goes something like that. So it's like, doesn't do much, underperforms. People are saying opportunity cost, but it's like at the end of the day, from here to here, that's a better return than from here to here in this one that basically just kept going up in a straight line. And yes, theoretically, there's an inflection point where it's like, well, if I sold this here and bought it here, or whatever, where the derivative basically outpaces this slope here. But it's like at the end of the day, I mean, that's more like almost scientific. It's like you don't need to be exactly right. Again, it's like the threshold is got. It's like what I was gonna say pisses me off. Like people think they need to be so goddamn accurate. I need to catch the bottom. I can't be in at any sort of short-term top. No, I mean it's like take. Well, first of all, in GDXJ nowadays, or GDX, it's like every single buy in this box is in the green right now, and even it's like periods of. Sure, it's not like it was too much to write home about, but like let's say all buys in this box were pretty good profit here. Every single buy in this box, pretty good profit here. Every single buy in this box, really good profit. I mean, it's like how much accurate do you need to be? You will still be making money. Most people lose money in this sector. Most people can't beat an index even in the general stock market. So it's like forget about being a perfectionist. Let's stop doing the obvious stupid mistake. Let's start small. Let's start with actually earning some money, making some money. You don't need anywhere near perfection for that. You just don't need to sell low, basically. If you buy low instead of selling low, I mean that's pretty much good enough in a cyclical sector. So yeah, I mean it's like let's have some perspective here, and then just get better and better. Yeah. Anyway, thanks for listening. Long talk again. If I mention any companies, assume I'm biased. Assume I own them. Assume I'm well, if some might be banner sponsors, twice biased in that case. Not buying or sell recommendations. Don't buy any stock because I own it or like it or talked about it, and don't sell any stock because I don't like it or not talk about it. Anything like that. And again, don't take this as any kind of Bible. Assume theoretically that I could sell every one of these stocks tomorrow. So again, it's like this is not a blueprint for just buy these and yada yada. This is just a snapshot. If I find something that's cheaper, I would be happy to sell anything if I find something cheaper. So yeah, again, this is not. You shouldn't be piling into these, but just because I showed this. This was to make a point about hodling and that you need time for winners to pay for a lot of losers, etc., etc. And you shouldn't buy any stock that you don't know why you own it. It's like that's how you get in real trouble. Anyway, Merry Christmas, Happy New Year. I mean, what's our goal for 2026? I mean, my goal is to be even more patient. My goal is to try to shut out 99% of all the noise because we get thrown. I mean, you can just imagine how much stuff we get. If you scroll Twitter for a week, I mean, imagine how many cases and impulses you get, like nickel there, copper here, platinum, silver, gold, and every day the metals trade in a different way, and news every day from different companies. So it's like it's bloody hard nowadays to hodl anything because you're just getting absolutely bombarded by stuff, opinions, movements, share price movements, metal movements, macro news, micro news, FOMO, fear, etc. etc. So again, I guess let's keep it simple here. Let's see, keep our eyes on the price. The price is that our portfolio does well over time. That's it. That's it. Over time, everything has to make sense over time. In my opinion, a strategy has to make sense over time. In the meantime, anybody can have the, if you want to have the best returns for 2026, you can start to gamble. Just be, note that the ones who have the best returns any year are the gamblers, and the worst returns every year are the gamblers as well. Yeah, just something to think about. Thanks for listening. Bye bye.